Hi, I'm Rick Kaler. Thanks for joining me. Well, is inflation going up, or are we more likely to see deflation instead? Or will we continue the current environment of low inflation? The jury is really still out. But it's not too early to begin educating yourself as to what investments you might want in your portfolio given each economic possibility. Even if you have a diversified portfolio of stocks and bonds, the wrong investment mix could cost you upwards to 2% a year. Now that's according to an article by Pen Chen called the Inflation Scenario. It was in the September 2010 issue of Financial Planning. If we have an extension of the current environment where inflation rates stay under 2%, well, this would favor a more traditional mix of global stocks and bonds. However, a prolonged Japanese-type deflation, and that's where prices decline year after year instead of climbing, presents a really different challenge. In this case, stocks, commodities, and real estate will probably do fairly poor, while government bonds are a much better choice. If, however, we return to a more normal economy where inflation averages, say, around 3.5%, the Chen study suggests that in addition to a normal mix of global stocks and bonds, you'll want to add commodities to your portfolio. Many economists fear it's politically impossible to raise taxes or cut spending enough to significantly retire our nation's debt, and that the government will then employ the third leg of debt reduction, which is inflating the money supply. In a period of high inflation, the asset classes that will probably do best are commodities, inflation-adjusted bonds like TIPS bonds, and real estate. Now, to the degree that the dollar sinks against global currencies, foreign stocks and foreign bonds may outshine their domestic counterparts. So this leaves us with two big questions. What scenario will play out over the next 10 years? And how will you know it's happening before it's already old news? Well, unless you follow current events really closely, have a little training in economics, and a lot of luck, you're just not going to know. In my 30 years of investment experience, the strategy that I've seen work very well is having a wide variety of investments that do well in a variety of economic scenarios. Then keep your hands off the asset allocation except for periodic rebalancing. While this strategy means that in any given year you're always going to have winners and you're always going to have losers, over the long run the odds are good that you'll do just fine. Chen's study found that from 1970 to 2009, a portfolio with a minimum of 10% to a maximum of 30% in each of these 6 asset classes outperformed portfolios that didn't have commodity exposure. And the 6 classes are U.S. stocks, international stocks, U.S. bonds, Treasury inflation protected securities, TIPS, T-bills, and commodities. Now, while this allocation underperformed a more traditional allocation of just stocks and bonds in a low inflation environment by about 1.5%, it outperformed it by about 2% during times of moderate to high inflation. So if you believe moderate to high inflation is in our future, you're seriously going to want to consider having a portfolio similar to Chen's, where you have some commodities and some TIPS, along with some international exposures. Now, in our portfolio, we go a little bit further. We use 10 different asset classes. That would include absolute return funds, some managed futures. Now, selecting a good mix of investment classes, this really doesn't have to be difficult. If you're in your employer's 401k or a similar retirement plan, it's possible that every asset class you need is represented amongst the plan's investment choices. If not, ask your employer to add the missing asset classes. I find that commodities, TIPS, and REITs real estate mutual funds, are most likely to be missing. So ask your employer if they would add that. If educating yourself about investment options just seems too challenging, don't rely on a coworker or your employer to select your retirement fund's assets. We know research says 80% of people do rely on coworkers to select their portfolio for them. If you need to delegate investment decisions, don't do it to a coworker. Consult a registered investment advisor who holds a CFA or a CFP designation. This whole idea of finding the right allocation for you and selecting the right investments is just too important to your future financial health than to delegate to a coworker or to be done blindly. Thanks for listening.